Hey, what's up, everybody? Welcome back to Passive Money. That's Alex. I'm Kirby. Last time I said it backwards, so Alex had to stop the video. But before we get started, I want to ask everybody to please like and subscribe. You know how the YouTube algorithm work. Subscriptions and likes will get the message out to many different people. But today we're going to talk about how what's going on in the stock market. People have more money. It's a lot of videos out there for people to talk about the individual stocks and things like that. But the thing that people usually forget about is a lot of people that just works a 9 to 5 job and invest in a 401k or pension plans or have an IRA. They are invested also. So Alex, the first question I got for you is, what rumblings have you heard between colleagues, peers, friends, and families about what's going on in the stock market or how their accounts are holding up in this situation?
Yeah, a lot of people that I'm hearing right now are talking about, how the stock market's going down. They're seeing their 401ks go down. Some people have a little bit in Robinhood or whatever, and they just see everything going down. Um, I think an important note to keep in mind for beginning investors, or let's say the majority of Americans that just have a 401k. When you're invested in the stock market, your money's not in a bank account growing interest. And I've heard that a lot from people like, oh, you make this percent of interest from your 401k or this or that. It's not interest, it's appreciation of a stock value. And then you also have stocks that pay dividends in a portfolio like that with for retirement. So when you see your money go down in a stock account, your your securities or your stocks, the shares that you have are still there. So if you had 1,000 shares of whatever in your 401k and you had 50 grand in your 401k, and now you look and it's at 35 grand, you still have 1,000 shares, but now you can buy those shares cheaper. And as the stock market rebounds, as history shows it does, then you'll have more appreciation on that stock. And I think that's just important to keep in mind is, don't get confused with your money is like in a bank growing interest. It's not how it works in a retirement account, whether it's a 401k, Roth IRA, or any stock account. It's all stock appreciation, and the asset is the shares that you have in those accounts, and that is what appreciates over time. So you kind of have to look at it different, because a lot of people, like I'm hearing, are cashing out their 401k, and this is like the worst time to cash out, because it's when you should be buying, if anything, because now you can actually get these shares that you already have in your 401k for lesser than a price that you would have been paying, say 6 7 months ago. And you can get those same shares, and in the future you'll see them come back. So but a lot of people are just cashing out their accounts in this time.
Yeah, and it goes to financial literacy. A lot of people don't even know what's in their 401k. I talk to people all the time and I ask them, hey, what are you? They say I have a 401k at work. And like you said, they believe it's just a savings account or something like that. And I always ask them what they're invested in. They say, I don't know, whatever the company put me in. Usually 99% of the time, if you have a 401k at work and you didn't select the investments, your company usually defaults you to a target retirement. So what they do is they take your age into consideration, and then they take the retirement age of 65 and how many years out from that, the closest rounded number. So it'll be like, let's say I'm 50 years old and I retire, and at 65 it'll be 15 years. So they would give me a target retirement account of 2040, and then because it's what that account does is it's supposed to be, the more time you have, like let's say you're in your 20s, it'll be more invested in riskier assets or riskier mutual funds, far as a lot of tech stocks and things like that, and it'll be like 10% bonds. But the closer you get to that retirement age, it lowers the level of stocks you have, and the more bonds, and it puts you in more bond, dividend type investments, so you don't have that much volatility going to the end or term of your, career. And target retirement accounts, they're okay if you want to be a D student in class. That's what I call it, a D student. You won't fail the class, but your retirement funds won't be as high as you expect them to be. And the reason why is because of the fees that those target retirement accounts charge you. It's usually double, triple, sometimes 5x the amount of fees that they'll charge you just for being in the index market. And if you check the index market or find a mutual fund in your 401k that's like that's indexed to the S&P 500, and the S&P 500 usually outperforms every other fund in the 401k, and it charges um fragment of a percent on the management fees. That will give you a better performance than being in a target retirement account. I've known people that's been working for years, 15, 20 years, and they're in these target retirement applications, and they still, they default you at 3%, or some people maybe 5%, and they still haven't even touched 100K in their 401ks.
Yeah.
And that's because the performance of the 401k, and it's also because of the low percentage of money they're putting in. And I'm not talking about some, Fortune 500 exec that's making, 500,000 a year, putting in 3%. 3% of 500,000 usually will max them out. But I'm talking about somebody that's making, 50, 40, 50, 60,000 a year, and they putting in 3%. You do the math, but that's a little bit of money, and then a company may match up to 3%. So you're putting in about 6% total, but that's just a couple $100. And that money is way better than putting zero. But if you're really serious about your retirement, you need to start looking at putting more. But I wouldn't put more in my 401k until, of course, I maxed out the Roth IRA first. But just getting back to the stock side of things. So I hear you say people talking about they're going to cash out their 401ks, or have they already cashed them out?
Yeah, some of them have already cashed out. I've been able to keep a couple afloat and just told them don't do it. So they haven't. But a couple of people have come to me like saying, should I sell now? And I mean, no. I mean, you never want to sell when the market is down. So
Yeah. So when they selling, are they taking the money out, or they just selling and leaving the cash in the account?
I don't know exactly. I'm assuming selling and leaving the cash in the account, but I can't confirm which one they are doing.
Right. And yeah, and it's a tricky thing to do, and it's hard for people to understand. But again, it comes to that literacy of it, of understanding what it is. A lot of people don't even understand what the 401k is. And even if you look on, social media sites, say, oh, people just put money in a 401k, but it's just like a brokerage account if it's Robinhood. It doesn't do nothing if it just goes into the 401k. It's actually sitting in an investment. And if you don't know what that investment is, or you haven't done the homework on the investment, or even looked at a prospectus of that investment, then you're gonna have trouble dealing with that fear euphoria phase of it when it comes to that. But it comes back to the knowledge. And I always believe nobody cares about your money more than you do. So if you don't understand your money, how do you expect somebody else to benefit you if you don't even understand what's going on? And that's why you have people selling at the bottom of the market. We had the same problem back in the financial crisis, March 2009, I believe that was the biggest exodus out of the 401k. And the crazy part of it is that was the bottom of the market in 2009 also. So they were selling absolutely at the bottom of the market. And then now you fast forward, and it's up 200-300% from that March 2009 low. And those people missed out. And you see that same thing in the, people with regular brokerage accounts and all that. The regular news don't talk about the Dow Jones and stuff like that until they talk about it while it's going down now, like, oh, it's going down bad. It's putting the fear out in the streets. But then once people exit at the bottom, the mass of people, the mom and pop people that jumped into the stock market when the stock market's rallied real big after COVID, they don't jump in again until the market is again touching another all-time high, which they missed all the gains from when it was down there at the low, going to the top. And that's just something that we're trying to convey to people is when the market is down, you got to have that reverse mindset. I mean, the first thing you're going to think of is the market's down, is down bad 20%, 30%, fear, sell. But in all actuality, you should have the reverse mindset. When you have that fear that the market is going down, you actually should be buying. You should be finding capital to put in the stock market. You should be raising the amount of your distribution that you're putting in your 401k. If you're at 3%, you should be jumping to 6%, 10% when the stock market is down. Now, when the market is euphoric and everybody's saying, oh, the market's going to the moon, it won't ever come down, that's when you should be allocating to take money out of your 401k, out of the investment, just leaving it in cash if you just want to play the, trader side of it. But besides that, I would always, and I still do it today, while the market is down, I am maxed out on all my retirement accounts. I make sure I put the max money in every retirement account that I can find. And then when the market starts taking off and going higher, then I will scale it back some, just saving up to deploy capital again, even if it's in a retirement account, if it's in my mutual fund account, or if it's even in my individual stock account now.
Right. And I think that's a huge point is financial literacy. Like how how badly do you want to retire, right? Like a lot of people, they're not thinking about that. They're not thinking about where they want to be in retirement. If you really wanted to retire financially free or financially well, then you would put as much as you can into your 401k. And I mean, I know you do it differently where you target the market when it's down, but for, the average person, in most cases I'm hearing where they're just doing the company match or below, and
Mhm.
the majority of their paycheck, they're just blowing all of that. But, you can, for our viewers, you can go on Google, look up account compound interest calculator, type in some numbers of, how much you're investing per month, for how many years, at what interest rate. The S&P 500 is 8 to 13%, and you can see what your projections would be in 10, 20, 30, 40 years on that amount. And for the most part, it's pretty accurate. It's probably not going to be dead spot on, but it'll give you an idea of where you can be in retirement. And the more you put, the more you're going to see in your retirement days. But it's a tricky time for for most people because it's definitely not taught. And I know you've mentioned this before. I don't think in any of the videos, but if your company, you said if your company wanted you to retire, then they would put you in financially savvy investments, but they don't do that. I mean, if you look at what the company has you invested in, it's probably bonds and different stocks, and you're probably getting 4% a year. But why are you making 4% when, like we said, the S&P pays a minimum of 8%? So, I mean, there's
Oh
a
yeah,
go ahead.
right over a long period of time, it does. The S&P outperforms many investments, especially in the 401k. And usually every 401k has a mutual fund that's pegged towards the S&P 500. It goes back to that thing you said, financial literacy and doing the work, like a compound calculator. We can pull the one up right here, right quick, and I'll actually share my screen when I get it up. All right. So in this situation here, a simple compound uh calculator. Let's just say we start off with $1,000 here, right? And then as we said that the S&P 500 averages over a long period of time. If you look at the S&P 500 over the past, over a 20-year period, it'll average between 8 and 11%. For this exercise, we're just gonna put 8%. We're gonna put the bare minimum in there, 8% interest rate, and then we're just gonna go 20 years, 20 years, and then the compound annual is we'll do it yearly. So it compounds 8% yearly. Uh, and then we deposit. Let's say we start off with 1,000. Let's just say we put in our 401k or our Roth IRA $500 a month, and then we just hit the calculate button. Let's see what we get. All right. So look again, $1,000, 8% interest yearly, 20 years. A compound interval is yearly, and then we deposited $500 a month. So that's if you get paid bi-weekly, that's $250 a paycheck. And then that's not increasing no matter, not even if you increasing the amount of money you putting in with raises, we're not even increasing or doing anything like that. But this is what the total comes out to. If it's 20 years from retirement, you earn 168,000 interest. Your total balance would be 289,000. That's way better than some people's 401ks and retirement accounts I'm seeing today. I'm seeing people that's been working for 20, 30 years and they don't even have 30 or $40,000 in their investment account. And this right here is an amortization calculator of initial deposit. You know, this is what the balance is. Then in a year, we put in $5,000 because that's $500 a month. So it's here. Interest of $300 here, 7,000. Accrued interest $300, and it just keeps compounding year over year over year over year. And this is over a 20-year span. So that's a little over $250,000 right there just by putting $250 a week. I mean, bi-weekly or $500 a month. And then, of course, you have that 401k match if you use it in a 401k. And then let's say $500, they matching that. So you put in $500 and the company is matching another 3%. So this could be up to $700 monthly with them adding to the match that's actually going into your 401k. And then you calculate that. You calculate that, and that's $400,000 in the 20-year period. That's again adding the match that the company is putting on. So there is ways. Let me stop sharing here. There is ways that you can actually make money, and a 401k is one investment vehicle, but a 401k should not be your only investment vehicle. Like I said, I always prefer to max out the Roth IRA first, and you can again invest in a Roth IRA just like a 401k, but not through your company, but through your own individual account. Roth IRA, max you can put in is 6,000 a year, and then when you put in the $500 a month or whatever invested in that S&P $500, the S&P 500 mutual fund that's indexed to the S&P 500. That's what I was trying to say, and then keep doing that. Put the $6,000 in there a year, and then start working on the 401k. So once you have that money going there, then you start working on the 401k doing that. So if you doing the 500 a month in the Roth, and then you're coming back doing the same thing in the 401k with the match, you're looking close to in 20 years. You're looking close to about $800,000 on average. But let's just say for I'm half wrong. If I'm half wrong, I love when people say this. If I'm half wrong, you're still sitting at, if you do that method, putting it in a Roth and then doing the 401k, if I'm half wrong, you're still sitting at about 400, almost a $500,000. If I'm half wrong on that. So let's say the S&P is not 8% and it's 4%. And if I'm half wrong, you're still sitting at close to a $500,000 over a 20-year period, which will set you up better in retirement, maybe help you pay off your house and have some money on the side. Then you got Social Security. If you're lucky enough to have a job that still pays pension, because there's not many out there, and then the pension could cover utilities and stuff, and your travel and all that, then you can have a pretty decent retirement. But that is the way that I would tackle the whole investment thesis. Alex, what you say about it?
I agree. Everything you said. I think it's very important, especially starting out. The younger you are, like I didn't start my 401k till I was 21, and I think I waited too long, even though it was only 3 years. But um, I think it's very important because, as you can see, like let's say you retire at 60, and people can use the same calculator that you use. We don't have to redo the whole thing, but you can see a huge difference from if you start at 18 to 60, so 42 years, compared to what the difference is on 39 years, where if you start at 21 and that 42-year mark, like
Mhm.
as your balance grows and grows and grows, 8% on 800,000, as you said, is a lot different than 8% on 10,000. And then, so by next year, then it's, you add the 8% to the 800,000, then it's 8% on top of that. And then it just compounds every single year, additional to what you're already contributing. So for people that, like you said, financial literacy, for people that want to take their retirement seriously, it is a great tool to use. But I also agree that people shouldn't be just investing in a 401k. I think there's lots of other investments, especially that aren't just for retirement, like retirement accounts that can still set you up for not just retirement, but for your life in general.
Right. And I'll leave the audience with this note. Warren Buffett started investing when he was 12 years old. And then now everybody knows Warren Buffett, $100 billion man. But just think, Warren Buffett started investing when he was 12. He didn't reach his first billion. He didn't get to billionaire status until he was 60. But the magic of how compound interest work, from 60 till 93, so 33 years later, he's worth 100 billion. Is because the compound interest, the more money you have in there, the compound interest pays you more. Like Warren Buffett started investing in a company, Coca-Cola, back in the 80s. And then now the dividend checks that Coca-Cola pays Warren Buffett on a yearly basis is more than he initially invested back in 1980. And he is probably the biggest shareholder in Coca-Cola. And you could say the same things about him in Bank of America, him in JP Morgan, him in Apple, and all those other ones. The dividend checks that they're paying him now is substantial compared to what he invested in, because of staying in the game for the long term, reinvested the dividends to buy more shares to keep it going. So folks that's out there, just stay for the long haul of the trip. No matter if the market's up or down, you keep investing, and you don't have to do it savvy like me or something like that, but put more in when the market's down. If you just keep investing a consistent sum, and I'll just leave it at keep investing a consistent sum. On the next video, we'll talk about the investments and how we decided to invest to grow our wealth. But just keep investing in a simple sum every month, over and over and over, and don't quit it, and make investing a priority, and you will be better off financially in the long run. With all that being said, thanks everybody for watching the video. Please like and subscribe. Help that YouTube algorithm out, and we'll see you in the next video. Have a good one.
See you guys.